All right, that didn't work. Good evening. All right. Glad there's 30 or 40 of you out there.
Where's the clicker?
Oh, I don't have the clicker.
Who's got the clicker?
Clicker's right there.
Oh, there's the clicker.
You're in charge.
Let me have the clicker.
Go ahead. So hello, everyone. Welcome.
Let me have the mic. For those of you who don't know us, I'm Mike Lehar, one of the founding partners.
I'm Ted Bavard.
He's younger.
Why go second?
We are two of the founding partners, and it's pretty astounding to us that this whole thing got started in 1995. And I know we don't look that old, and that's because we started the firm when we were 14.
I was 10.
He's younger. What is really making the two of us feel really good right now is when we look around the room, there are people in this room that have been clients since before we started Fort Pitt Capital Group. So we've got clients here that have been with us for more than 30 years, and now we have multi-generations of clients.
It's unbelievable that we met some of you when we were 10 and 14. So thank you for believing in us. But again, I think I've said this the last few years, this is the biggest turnout we've ever had because every year it's the truth. So I think we had 550 some signed up for this evening. So thank you very much. Big night. We were in, for those of you who missed it, and I'm sorry, we were in Florida last week and had about 90 folks there. The week before in Harrisburg had about 100 there. So it's been quite an experience, and we're just so glad to see all of you here.
We hope you enjoyed seeing all of the life events of our team from last year. It's great to see everybody out there enjoying themselves and having fun with their families and fun at work. One thing I do want to clarify. Todd Dowds is our COO, and I know his fish was bigger than my fish. But
a lot bigger.
Todd was using bait, and I was using a fly rod. So I just want to make that clear.
I'm just glad that's not an issue for you.
Yeah, it's an issue.
Todd, you know what you got to do. It's it every year, a bigger fish. Hey, so 2023 was a great year for the firm and consequently all of you. Bill's going to take us through some of the milestones that we've reached both as a firm and some of the folks of our employees at the firm. So it's kind of fun. You'll get to see kind of what the year and what the big success it was in so many ways. So we thank you for all of that because without you, none of this is possible. So we don't forget that. So thank you very much.
So we'll just say that we really appreciate all of your support. We appreciate your friendship, and we hope you have a great evening. And now we're going to turn it over to Bill.
Bye, Doug. All right.
Good evening, everybody. Thanks, Mike and Ted. And for those that don't know me, I'm Bill Engel, one of the senior advisors here at the firm, and it's incredible to see how many of you came out this evening. It's always so fun for someone that didn't start in 1995 to see how many folks continually come every year. So honored to be the MC this evening and kind of tell you about the agenda. First thing we're going to do is take a little tour through the state of the fort, things that are happening with the firm or happened in 2023. Then we'll have a brief housekeeping, and then I'll get to introduce the key speaker, the person you came to hear tonight, Chief Investment Officer Dan I. And we'll follow that with a brief question and answer, and then we'll get the party on. So let's start with the state of the fort. So we are growing, and we hired in 2023 18 new folks, and I mean that's a remarkable thing. But we need all those folks to help support you and to be able to support hopefully lots more folks like you. So if you are a Fort Pitt staffer, would you please stand and be recognized? There should be a lot of them. And we love to celebrate our teammates' professional achievements, and so we had 7 promotions in 2023. Similarly, though, we like to celebrate our teammates' personal achievements and goals. And so, for example, we had 2 of our folks got to buy a home in 2023, and that's really exciting to be able to enable them to meet their goals and dreams. We are growing outside of the office as well. We had 3 Fort Pitt babies in 2023. Take no credit. And we have one more due any time now, I think next month, Bryson and Susie out in Harrisburg. So we continue to grow. On a bittersweet note, we did have one retirement in 2023. Many of you, I'm sure, knew and remember Robin McMillan, who was our receptionist, and we said goodbye to her in 2023. But again, very ecstatic to be able to be a part of her achieving her ultimate financial dream of retirement. And then we had only one car fire in 2023. That was exciting. So anyone wants to know where not to take their car for an oil change, I'm sure Skylar Riddle will be happy to give you some insight there. And if anybody's looking for an amateur fire marshal, Beth Lynch showed tremendous grace under pressure, shepherded us all safely out of the building. But in all seriousness, nobody was hurt, and now it's just a good story. So that was the state of the fort in 2023. Now some milestone numbers. The Fort Pitt by the numbers, all you Penguins fans know that. And first one's a big one. This means a lot to us because this is kind of how we are measured in the industry, but we eclipsed $5 billion in assets under management. So that's very exciting. We're very proud, but of course, we can't do that without you, right? This is a shared achievement because it's the trust and confidence that you've shown in us that allows us to do that. So give everybody yourselves a round of applause. And let's shoot for $6 billion next year, right? The next bullet, this is kind of how the sausage is made. There's a lot of work that goes behind the scenes for that $5 billion, right? And so 220,000 trades, equities, bonds, and mutual funds. That amounts to about 4,200 a week. 4,200 a week. That's a lot of work. And our asset management and trading teams do a fantastic job. Our insights, our thoughts are valued in the industry. And so we had over 120 media appearances. Maybe some of you have seen Dan on TV or some of our other Fort Pitt colleagues. We have magazines that want to have our contributions. It's exciting to know that people want to know what we think out there. Every person in this room got a personalized financial plan when you became a client. And similarly, we've run retirement cash flow projections or Social Security scenarios. All of that runs through our planning team. A lot of high-end technical work, and that planning team achieved 984 completed requests last year. That's about 80 a week. So again, incredible volumes that are handled masterfully by the team. We have a 401k business at the firm, and they just had an incredible, stellar year. They brought in $100 million in retirement plan services. And that's fantastic on its own. That's great new business for us. But what's really important there is that gives us access to all of those plan participants, all those individuals that are in those 401k plans, and we get to bring our expertise and our high-end service to them to help them achieve their financial goals. So very rewarding both financially and to help people achieve their dreams. This last one, again, it's probably the most important one. Everybody in this room likes to go on vacation. You like to buy cars and pay bills and eat food. All of that requires money. And you've entrusted us with that money. We've sent out in 2023 over $250 million for you all to live and have fun. It's worth mentioning that $250 million, that's bigger than a lot of investment firms have in their assets under management. We just sent that out for you guys to enjoy your money. So we take that very seriously, and we're very proud of that. So those are the numbers. Now a little bit of housekeeping before I introduce Dan. First thing is the dinner tickets. You should have gotten a ticket that has your meal selection on it. So when the servers come around to give you your salad, you're going to hand them their ticket so they'll know what delectable meal to bring to you. If you have any questions, all those Fort Pitt people that stood up, you can ask any one of them. They'll help you out. Parking. If you parked in the Weston parking lot, on your way out this evening, you'll want to make sure that to stop by and get a validation sticker. The way it was explained to me, you will put your parking ticket in first, followed by the validation ticket, and they should let you out. But again, any questions about that, you can ask on your way out. Finally, and most importantly, our gift to you this evening is a beautiful set of etched rocks glasses with the Fort Pitt logo on it for you to enjoy your water, your warm milk, whatever libation you decide you want to share and think about Fort Pitt Capital. As always, we ask if you came by yourself, feel free to take a set of glasses. If you came as a couple with your significant other, we ask you to take one set of glasses so that we make sure that we have enough for everybody. So finally, again, if you have any questions, be sure to ask a Fort Pitt Capital person. So with that, allow me to introduce the person you came to hear from tonight, Chief Investment Officer Dan I. Dan has over 20 years of investment experience in the industry. Started his career at JP Morgan, handling portfolios for high net worth clients, and joined the firm, I think, in 2015, and in 2021 was named Chief Investment Officer. So we're thrilled to have him, and with that, please help me welcome Dan I.
All right. Thank you, Bill. Welcome, everybody. Thanks for coming out and spending some time with us tonight. We really appreciate it. And to show my appreciation, I have a 973-slide PowerPoint presentation. Goes into great detail on every trading day throughout 2023. It's going to be great. We should be out of here by about midnight. No, I should keep it a lot shorter than that. So, as usual, let's start with our report card on our forecast for last year. So we called for a mid-single-digit 6% return for the S&P 500 index. That was obviously way too low, with the S&P actually up 24% in price terms last year. Sure, I like it. So I will say, while our forecast was too conservative, I do think we did a good job of pivoting and adjusting to the environment and portfolios throughout the year. Here I have some bullet points that really outline some of the factors that we think really contributed to the better than expected outcomes. And I'll just dive into a few here. First, the economy remained very resilient, and we think that that's primarily attributable to how well prepared both consumers and corporations were for the higher interest rate environment. And second, a handful, or more specifically, 7 very large technology stocks, now dubbed the Magnificent Seven, performed extremely well last year. And given that those stocks are such a large portion of the S&P 500 index, it really boosted the S&P. So 2023 really does go down as a year of very concentrated returns. And I think this chart really outlines what I mean by that, those concentrated returns. So just to walk through this slide here, we show different returns for various asset classes last year. So just to kind of walk through this, small and mid-cap stocks are up about 17% last year. International stocks up 15.5%. Value stocks up 11.5%. So it was a good, solid year really across the board. But we can also see at the top of the chart that the S&P 500 index outperformed all other asset classes and by a pretty wide margin, up more than 26% in total return. In the white shading, you can see that those magnificent 7 stocks, or more specifically, Amazon, Apple, Alphabet, NVIDIA, Meta, Microsoft, and Tesla, say that 5 times fast, those actually accounted for 86% of the S&P 500's return last year. And that doesn't happen very often. In fact, we have to look back to the 1970s to find a period of time where such a small number of stocks accounted for such a large portion of the index return. And I think if we compare, again, the S&P 500 at the top, up more than 26%, to the equally weighted S&P 500 index that we have highlighted in blue, only up 13 or 14%, I think it really highlights my point. Same exact 500 stocks in each one of those indices, but the very large weighting to those 7 names really propelled the market cap weighted S&P last year. I think it makes sense to spend just a couple of minutes and take a look at how things look after a year of such massive outperformance from these mega cap tech stocks. It's pushed the S&P 500 into fairly concentrated territory. And if you talk to an index investor about the benefits of investing in an index, at the top of that list is always diversification. You're not overly exposed to a small number of stocks. You have broad diversification across all market sectors. Well, that dynamic is changing with the S&P now that the top 10 stocks represent nearly 1/3 of the entire index. So the S&P is becoming overly concentrated in high growth technology stocks. And that was a great outcome last year, no doubt about it. But I think it's also left us at the point where if those 7 or 10 stocks don't perform well going forward, it's going to be difficult for that index to make a lot of progress. Here we show a valuation comparison of those top 10 stocks compared to the overall index. And in our little box in red there, we show that those top 10 names traded almost a 40% premium compared to the overall market. And in full candor, those top 10 stocks do deserve to trade at a market premium. There's no doubt about it. They're very dominant businesses, and that's easily reflected in their growth and profitability profile. But I think what it tells us is that investors' expectations are extremely elevated for those companies. 40% is a very large premium. And if their results in terms of earnings and growth don't match up with those elevated expectations, we think it's going to be difficult for those stocks to maintain such a high valuation premium. Okay, so let's switch gears and talk a little bit about the economic outcomes from last year. I think back to how we started out 2023, and the general consensus among economists and market pundits was the Federal Reserve's very aggressive interest rate hiking cycle was going to choke off economic growth and put us into a recession. In fact, there really wasn't even a debate about if we were going to have a recession. It was, when's it going to start, how deep is it going to be, and how long is it going to last? But not only did we avoid a recession last year, economic growth was above long-term averages, above long-term trends. And again, we would attribute that to how well-positioned consumers and businesses were for those higher interest rates. So I think this chart really does a good job of illustrating that point, especially with consumers. So to the right of the chart, we show the absolute massive spike in mortgage rates over the last 2 years, which moved from 3% all the way up to 8% at one point late last year. But at the same time, the vast majority of homeowners, more than 80% of homeowners have fixed rate mortgages at very low interest rates. And in fact, we can see in the chart in gold there that the average mortgage rate is only 4%, and that's actually down compared to where we were pre-pandemic. So homeowners, consumers, were smart borrowers back in the beginning of 2020 and took advantage of the ultra-low interest rate environment to really refinance those mortgages, to refinance their balance sheets, and it's left them very well insulated from higher interest rates. And really the same dynamic on the corporate front. Again, smart, opportunistic borrowers. They borrowed a ton of capital in the beginning of 2020. They borrowed that capital at very low interest rates, and they locked that capital up for very long periods of time. So we show some of those dynamics on our slide here on the left. You can see that the average interest rate that S&P 500 companies are paying on their debt is only 3%. And the average maturity of the bonds on their balance sheets is very long. It's 8.5 years. So the point being, corporations just haven't been forced to borrow a lot of capital at these higher interest rates and have left them well insulated. We would also put inflation into the category of, or factors that supported better than expected outcomes last year. And we've got a lot going on in this slide. We kind of break down the different components of inflation. I won't get into that much detail, but a couple of important points here. First, if we look to the left, we can see that inflation peaked out at over 9% back in June of 2022, and we ended last year with inflation hovering a little bit above 3%. So we're not exactly where we need to be, but we are encouraged with the progress that we've made. We expect to make continued progress throughout 2024 as well. And just one other point here is that you can see on the right, our little arrow there, we indicate that shelter or rents or the housing component of inflation is by far the largest component at nearly 35%. So it's very logical to assume that if shelter inflation is overstated, then the entire inflation calculation is a bit overstated, and that's really what we see. Here we take a look, and that kind of puts this point into context. So the blue line shows that shelter inflation is still up 6.5% year over year, and that's what actually goes into the official inflation readings that we see on a monthly basis. But that's high, and it's too high. We know it's too high, and so does the market, and so does the Fed. And it's too high because it's including leases or rents that are being signed today, but also leases and rents that were signed 8, 10, 12 months ago when inflation was just higher across the board. So the little orange line there shows that leases that are being signed today are only up a little bit over 3%, and that's back to in line with long-term historical averages. So we're very confident that these two numbers will converge over time. They'll converge at lower levels and help to bring inflation down in 2024. Okay, so I think that's a decent recap of last year, kind of turning the attention to our outlook for this year. I think the biggest, most consequential question is still, do we have a recession? And our view is no recession in 2024, but slower economic growth compared to last year. Really because, we are dealing with a number of fairly visible headwinds and also some things going on in the background that could certainly turn into economic headwinds as well. So here we show monthly job gains or additions to the payrolls, really monthly job growth for the last 3 years. And I think it's pretty clear that trend is starting to slow. And we think that's indicative of, some companies feeling some of the pinch of having to roll over their debt at higher interest rates and also higher wage costs, et cetera. So we do expect this slowing trend in job growth to continue in 2024 and to be, somewhat a weight on economic growth. Here we look at consumers' excess savings. And, what do I mean by that? Just simply how much cash consumers have in the bank compared to long-term historical averages. And we can see the absolutely massive spike in, March of 2021 after the third round of stimulus payments. Consumers were absolutely flush with cash. I think it's easy to say that really supported and acted as a tailwind to consumer spending, which accounts for 70% of our economy. But we can also see where we are now on the right side of the chart. Those excess savings levels are almost fully depleted. We think they will be fully depleted in the first quarter of this year. So less of a headwind for consumer spending, less of a tailwind for consumer spending going forward. Here we take a look at bank lending activity, or the change in bank lending activity for both small and large banks. And obviously, as banks get more conservative and tighten their lending standards, it's more difficult for consumers and businesses to access credit, and it tends to slow the economy. And if we look to the top right of the slide here, it goes back to March of last year, after the collapse of Silicon Valley Bank as well as some others. And we can see that since that point, banks have started to get more conservative. They have started to pull in the reins as they focus on rebuilding their capital and strengthening their balance sheets. We can see by the little dotted lines that conservativeness is expected to continue. We think that that's a logical conclusion and, again, should slow economic growth. Here we take a look at consumer delinquency trends for both credit cards and auto loans. And we can see those delinquencies are starting to trend higher. Something that we're keeping an eye on. We're not overly panicked about the trend at this point. We think this is more of a normalization from very, very low delinquency levels after those 3 rounds of stimulus payments, where it was very easy for consumers to pay off or pay down their debt levels. So something that we're keeping an eye on, something that has the potential to turn into a headwind this year, but not something that we're panicked about at this point. And then finally, we've got a lot of questions and concerns about the commercial real estate space. And I think those questions are really geared towards, does weakness in commercial real estate impact the banks and translate into systemic risk for the economy? And I'd say we have generally more of a positive view or optimistic view than the kind of negative narrative that's out there, really for 2 main reasons. First, the large money center banks and even the super regional banks that we tend to focus on in portfolios, they don't have a whole lot of exposure or manageable exposure levels to commercial real estate debt. And the other is, I think once you really look at the different sectors of the commercial property market, some of them are doing very, very well. So here, let me just walk through some of these. In green, industrial, warehouse, logistics assets are doing very well. The lowest vacancy rates in more than 20 years. In orange, apartments, really business as usual. Vacancy rates are in line with long-term historical averages. The real stress and problems are specifically in the commercial office space. And I think here you even need to be a bit more granular. There's certainly a lot of problems. There will continue to be problems with commercial office buildings in downtown metro areas. I think that's a much different picture than a lot of suburban locations. So I think it's one where investors really need to kind of dig into the different property types to understand what's going on in the real estate market in general. And I think once you do that, you see that there's not broad stress across all sectors. Okay, so we talked about some of those headwinds, but again, we maintain the view that we don't have a recession this year, mainly because of the tightness in the labor market. So this is probably my favorite slide of the presentation. I know I'm a bit of a nerd, but anyway, what this shows is in the blue line, there are almost 9 million job openings out there right now. And in the gold line, it shows that we only have about 6 million unemployed people. So the labor market is very tight. There is not excess capacity out there, and companies know this dynamic very well because their biggest problem or challenge over the last 2 or 3 years has been attracting and retaining workers. So we think that dynamic keeps companies very hesitant to move forward with the type of deep and wide-scale layoffs that would translate into a large spike in the unemployment rate. And at least historically, we don't get a recession unless we do have that spike in the unemployment rate. Here we take a look at short-term interest rates, or more specifically, the Fed funds rate over the last 30 years. If we look over to the right, we can just get a really good graphical or visual of how aggressive the Federal Reserve has been. They've raised interest rates from 0 to over 5%, and they did it in a span of 18 months. If we look a little farther over to the right, we see the little dotted lines and the diamonds reflective of the market's expectations as well as the Federal Reserve's own forecasts for interest rates going forward. And we can clearly see expectations are for lower interest rates or for interest rate cuts this year. But that's not really the main point I want to make on this slide. The main point is that the Fed is now in a good spot. They're in a good position. They have a lot of ammunition or firepower to cut interest rates in order to support the economy when we do have a period of economic declines or a recession. They haven't been in that good position for most of the last 15 years since the great financial crisis. So the Fed does have a lot of tools in the toolbox. We think that's a big positive for the economy, not just in the here and now, but for the intermediate term as well. All right, so I'm going to start to pull it all together and wrap things up with our outlook for the S&P 500 index this year. And I think I've got some important caveats that we need to talk about as well. So at the high-level economic front, we expect, again, to avoid a recession, but also slower than trend economic growth. So we're penciling in 1.5% for GDP growth this year. We do think it's very possible that we have a continuation of the environment that we've dealt with over the last 12 or 18 months, where we kind of have these rolling recessions, sporadic economic weakness in different pockets of the economy, but not broad or deep enough to pull the entire economy into a recession. On the corporate earnings front, we expect $237 per share in earnings from the S&P index, and that would translate into 7% growth for the year, which we think would be, a good, solid outcome, but not quite as optimistic as current analyst expectations for 12% earnings growth this year. We think 12% is a bit too optimistic given our expectations for a slowing economy. It's going to be difficult for companies to grow earnings at a double-digit clip if we do have, weaker than average economic growth. And second, we also expect to make more progress on the inflation front this year. And if that's the case, it's going to be more difficult for companies to pass through the same type of aggressive price hikes to their customers that they've been able to get away with for the last 2 years. In terms of evaluation, we're using a PE, or a price to earnings multiple of 20. In full candor, 20 is above long-term historical averages, but also reflective of expectations for two big positives for stocks this year. One, that the Fed cuts interest rates and cuts multiple times this year, and also that we get inflation back down to the 2-ish% level. I think if we look back this time next year and say those things didn't happen, we'll probably conclude that that 20 times multiple is a bit too optimistic. So if we put those two numbers together, $237 in earnings times that 20 multiple, we get to our 2024 outlook for the S&P of 4,750, which is actually a 1% decline compared to where we ended last year. I realize that outlook probably doesn't get anybody overly excited. I don't see anybody jumping out of their seats now. Give you a couple more minutes. No, but I think this is why my caveats are pretty important. So first, we ended last year on an extremely strong note. In fact, the S&P 500 was up more than 15% in just the final 2 months of the year last year. So not only did Santa Claus come last year, but he was a bit overly generous to investors in our view and really pulled forward some of the returns from 2024. Second caveat, which I think is most important, is, well, we don't own the S&P 500 index in our portfolios. And I'm just going to say that one more time. We don't own the S&P 500 index in our portfolios. We own a well-diversified, balanced approach, with great businesses. So I think after what happened last year, and I'll wrap up with some comments here, we think it's very rational and reasonable to have a bit of a diverging view this year. Fairly tempered expectations, again, for the S&P 500, but much more positive, optimistic, and bullish expectations for our well-diversified portfolios. And here's just a couple of slides that really kind of reinforce that view. So what are we showing here? The Magnificent Seven stocks last year compared to everything else. Those 7 stocks as a group were up almost 80%. Heck, some of them were up close to 200% last year. So we're pretty confident that it's going to be very difficult for that outcome to repeat itself again this year, and it's left the S&P 500 index overly exposed to expensive stocks where investor sentiment and positioning are already extremely bullish. And at least historically, that hasn't been a great recipe for a future return. So the Magnificent Seven had its day in the sun last year. It'll probably have many more days in the sun in the future, but it's not where we're overly excited about in 2024. Where we're excited is, the bottom of the chart here, the laggards from last year, the other 493 stocks that didn't participate to the same degree. And it's actually a much deeper pool than just those 493 stocks. It's also small cap stocks, mid cap stocks, and add to that, as we all remember, 2022 was a pretty rough year for equity markets in general. So the point being, we see a very broad and deep pool of opportunities in great companies that are on sale after outcomes of the last 2 years. So we expect to see a rotation this year. Less of investors continuing to pile in and chase the momentum of the Magnificent Seven tech stocks, and into some of the areas of the market that have really been passed over, overlooked, and in our view, neglected. And specifically, that's areas of the market or sectors such as healthcare, energy, real estate, and financials. So sectors where we just don't have reservations or concerns about valuations or overly optimistic investor expectations. So we expect this rotation to be much more beneficial for our portfolios compared to the S&P 500 index because we're well diversified and we have more exposure to these specific sectors. So we did see some, a glimmer of this rotation to close out last year. That better market breadth and depth was very beneficial for our portfolios. Everything that we look at, all the metrics and valuation, leave us to conclude that this rotation has a long way to go, has a lot of room to run, a very long runway. So we dub 2024 as the year of the great rotation, and we feel very well positioned and prepared to take advantage of it again, because I think that just explains kind of the diverging views this year, one that may not be extremely optimistic for the S&P 500, but again, much more positive, optimistic, and bullish about what we own in portfolios and our diversified approach. So with that, thank you for your time. I'll go ahead and wrap things up and invite Jay Samariva, our head of asset management, director of fixed income. I'll think of some more titles while you're walking. And I'll bring Bill back up to the podium here to MC the Q&A section.
All right. Thank you, Dan. Really good insights there, and some exciting news about the magnificent 493 that we're going to see next year, right? All right, so we had a terrific response to our request for questions for this evening, and so we were able to compile and kind of filter down to either the most common questions or the most poignant ones, and so we picked a few. And Jay, Dan, and myself will ask and address these questions. If you have a question that we don't address this evening, make sure that you grab your advisor or an employee at Fort Pitt, and we'll be happy to address them for you. So first question, I'll address this to Jay. What are your predictions for interest rates and fiscal policy, i.e. tapering or easing, in 2024? And what is our strategy within the fixed income bond portfolios for the next year or two?
Well, thank you. I had this all figured out a couple days ago, then the Fed came out yesterday, so let's just throw that away. But they actually reaffirmed what we have been talking about the last couple of weeks, and we do not believe that the Fed is going to be as aggressive as the market has priced in to eases in this coming year. Dan had some pretty good graphs among his 896 that were up there. And it showed where interest rates have historically been in the past, and how it jumped up in the last 18 months. So we had 11 tightenings in the last 18 months, obviously starting at 0, and then getting up to where we are right now at 5.25, 5.5. Historically, that may be a tad high, but not that much. So, in my view, and we've talked about this. So obviously, I believe the Fed may go 4 times this year, maybe 5. But, I think we need to remember that the Fed's job is not to prop up the stock market. I know that has happened in the last decade or so, but, their job is to keep inflation down and employment up. And in those scenarios, the companies should be able to do well, and therefore the market will do well as well. So, if we could hover around 4.5% maybe by the end of the year, I think that's probably equilibrium, and still give them the opportunity to lower rates in the future if there is some sort of other crisis that they need to take care of. So I think the second part of your question was how are we repositioning our portfolios, or?
Yeah.
So, doing it now is too late because everything has been priced in. So we've been thinking about this, obviously, probably for the last 8-9 months of what 2024 was going to look like. And about 8 months ago, we started to extend our portfolios a little bit out on the fixed income side to lock in some of the the interest rates that have finally been available for our clients that we haven't seen in the last decade or so. So generally, we would go from 1 to 5 years and sort of ladder that out. We extended that, not by far, maybe, out to 6 years. And we also, which we haven't done in a long time, we purchased the 10-year Treasury once it got above 4%, to lock some of that in too. If the historical Fed funds rate is around 4.5, getting a 4% on a 10-year Treasury, we think is advantageous, especially after we've had 0 for the last decade. So just to sort of wrap that question up, we changed a little bit, but not that much that it's going to be that noticeable. So.
All right. Thanks, Jay. The second question was, and I'll handle this one, is should I convert my IRA to a Roth IRA? This is a question we've gotten for years and we've talked about, but and it used to be primarily for the owner of the IRA. Is it current versus anticipated tax rates? What makes the most sense? But and that's still part of the case, but it's gotten a little bit more complicated and a little bit more urgent because since 2019 and the passage of the Secure Act and the elimination of the stretch IRA, none of this is on the exam, but now if beneficiaries inherit an IRA, it used to be that they had their life expectancy to take that money out and had to take required minimum distributions. Now that has to be depleted in 10 years. So if you're inheriting an IRA and you're a high earner and you have to now take a pretty substantial extra RMD every year, Uncle Sam gets a pretty significant cut. So we find that it's partially a tax play and partially it's a tax play for your heirs, and so it's become a much more common issue for us to discuss. Certainly, you should be discussing with your Fort Pitt advisor and probably your tax advisor as well. One thing that I'll just add is that we find there's a sweet spot typically between retirement and the age that you need to start taking required minimum distributions that gives a really good opportunity to not eliminate taxes, but at least control the rate that you're paying at. So certainly it's common and it's an important thing that you can be thinking about doing and should be talking about it with your advisor. Third question, we'll direct this to Dan. What influence now or in the future will AI, artificial intelligence, have on financial markets? And do you plan on using AI in the near future with your investment decisions?
Yeah, no, it's a good question. I'll take the second part of that first, and the answer would be, no. We want human beings to be making our investment decisions, and we want those investment decisions to be the result of a well-structured, fundamental-based research process. And I don't see that changing. But I would say we would welcome any tools that allows us to gather and sift through data more efficiently that may help us to make those decisions. In terms of how AI is impacting the market, I think we've seen a lot of good examples over the last 3 or 4 years of when kind of the Wall Street hype machine gets out of control, right? I remember seeing it around the blockchain, which we don't talk about anymore, or the metaverse, which again we don't really talk about anymore. I think AI is certainly a different animal. It's real. There is a long-term secular growth story there. We're already seeing some of the large cloud companies and semiconductor companies, many of which we own in portfolios, benefit from the technology now. But I would also say that expectations here are just so high. And nobody knows exactly, what the long-term, addressable market looks like over the next 5 or 10 years. So I guess the point is that, we think that investors are going to need to see the money this year, right? It's not going to be good enough for a company to just talk about their potential opportunities in the AI space. They've already done that, and that's what's, moved those expectations up. This year would have to be the result of companies actually showing the use case for the technology, how they're using it to become more profitable and efficient, and how it's impacting the bottom line. So, investors want to see the money this year.
Great. Thanks, Dan. This next one's a good one, a very popular one that we got. It's for Jay. With 2024 being an election year, how do you envision the outcome impacting financial markets, and what changes are you implementing in portfolios as a result?
We flipped that early.
Yeah. So I haven't even said anything yet, and half this room hates me. It wants to start to argue with me about it. But Ted's like, no, please stop. But the reality of it is, again, resilience. I know Dan said it many times, but the American consumer, the American investor, Americans in general are resilient. Tell us what the rules are, and then get out of the way. And then we'll move around, we'll figure out how we're still gonna get to the end. But just tell us what the rules are, and we'll figure it out from there. And this is actually an easy question, because the two front runners, we have data on both of them and how the economy and how the markets have done in both instances. And, we've been able to navigate through both of those and have done quite well, actually, in both of those, doing different, getting there in different ways. So, if these two are the, we end up with at the end, which is still we'll see. But I think we're still going to be able to do fine because we've seen it already in the past, and we know how to deal with both of them. So, I'm not really too concerned, I guess, about the actual economics of what happens in the election. How'd I do? Did I offend anyone?
Seems like only half still hate you, so that's good. Good job. All right, last question, and then we'll start to wrap things up here. But for Dan, we've had a wild ride in equity markets over the past 3 years with many significant and unforeseen outcomes. What has been your biggest takeaway?
Oh, that is a good question, and probably a good one to end on. It has been a wild ride. We have seen a tremendous amount of unexpected outcomes and developments over the last 3 or 4 years. And I think just to kind of steal some of Jay's thunder, my biggest takeaway would be, how resilient the economy is and how resilient our financial markets are. I just think back to March of 2020 as a starting point, right? We had the market down more than 30% in 19 trading days as we shut down the global economy. 5 or 6 months later, we recovered all of those declines. In 2022, we have inflation spiking to the highest levels since the 1970s. And then we have the Federal Reserve unleash the most aggressive interest rate hiking campaign in 43 years. And we're through all that. Markets have worked their way through all that. Where are we now? We're right back to all-time highs in markets. It often takes some time, but markets are resilient. And I just think that, during those last 3 or 4 years, a lot of opportunities for investors to have made a lot of big, impactful mistakes. But the ones that focused, thought about the world like a long-term investor, and stuck to their plan, their investment plan, when things get rough, as usual, made it through just fine. So resiliency would be my biggest, takeaway.
Right. Dan and Jay, thanks so much for your insights. And, the truth is, we're never going to escape market volatility, but that's why you have us, right? And you have an entire team of people who are experts. We're watching the markets. We understand you and your unique situations, and we're ready to hold your hand and guide you through whatever the world throws at us out there. So, we have some core values here at the firm, and we refer to it as the Fort Pitt way. We put clients first, take that very seriously. We take initiative, so we're not reacting, we're being proactive. We are solutions focused, not product focused, and we follow through. And then, most importantly, all of us, we're all in this together. So hope you feel that way, and we certainly do. And I want to thank you for your attention and your attendance. And now let's enjoy our meal and time together. So thank you.